All right, so an ETF strategy that has an amazing 31% annual return, and it's based off of the NASDAQ 100. That's what we want to show you today.
And why are we using the NASDAQ 100?
Because we love the NASDAQ, especially ETFs or the index, right? So the index includes the top 100 companies, and the big tech giants are in there. We love the NASDAQ because it always is accumulating and shedding off the weak ones, the weak companies,
and bringing on the strong ones. Yeah, we're trying to eliminate that human element, that human variable that can, skew and throw off, some of these formulas that we have.
Yes. So this is what we're going to do. We're just showing you the high level right now. This is what the back test looks like on the strategy back to the year 2000. So 24 years worth of back testing. A little less than 32% annual return with a drawdown of 39%. Okay. So we're going to go into those details here in a moment and how we get there. But let's just start with the ETF, right? The NASDAQ 100. What we do is we take the QQQ, which is one of the oldest ETFs. A lot of ETFs are a couple years old. A lot of them go back to 2010 era, but really the SPY, which is the S&P 500 ETF, and QQQ by Invesco, that one is really old. I mean, they're back.
I didn't realize how old it was. I mean, that's almost 25 years old.
Yep. And then anyway, annual return is 9.9%. That's the buy and hold.
That's just the buy, as we say, buy and get old. Just hold it and just boring.
Yep. And so let's just say you were to buy and hold, and you bought it the year 2000. That's 24 years ago. What would it look like? Okay, you would buy it. You'd have to go through the .com bust. You'd have 85% drawdown. So if you had $100,000 in your account, really, you'd only have $15,000 at the very bottom.
And looking at this chart, I think does a little bit of a disservice to our viewers because you're thinking, 85%. That's okay. I'm a long-term investor.
Yeah.
I buy and hold, no problem. No, trust me, you wouldn't have actually been holding it, back in 2004 and 5 because you would have sold it, after 2002.
Everyone thinks
you would have gotten scared to death.
Yes, the panic sets in, and that is what we want to avoid. We want to avoid drawdowns.
Right. We want the opposite. Instead of you panicking and getting out, we want you to see opportunity and get back in. But guess what? Our psyche doesn't do that. But this automated system that we put in place forces us to do that.
So 85% drawdown, 54 during the Great Depression, 23% drawdown at the end of 2018. COVID was 30%, and then since 2022, there was that drawdown about 37%. So if we apply this strategy that we're talking about to that over those 24 years on the NASDAQ, this is what it does. It only has a drawdown. The maximum drawdown is 15%. So that's one of our first goals, preservation of capital. We want to preserve our cash. The return is, the overall return is 1,271%. Now, this is a TradingView strategy backtester. So, it's not a perfect science. This is taking all that trading data and giving us this information. But this is what it looks like. Annualized over 24 years is 11%. So 11% over 24 years, it's pretty good. I mean, 11% is a good return. But it only comes with the drawdown of a little less than 15%. But again, remember, that's really, how do we get this up to 30%? First, we control the drawdowns. Now we can apply some leverage. All right. The leverage is when you are responsible with the leverage, it works.
Now, why do we have to control the drawdowns in order for leverage to work? It's the margin, or it's having the bandwidth,
right? Because when the fund, so here's the TQQQ. It's the triple leverage NASDAQ 100. So it's the triple leverage. For example, QQQ.
It hasn't been around that long.
And it's been around since the February 9th, 2010. All right, so it's 3 times the result. So if the NASDAQ 100, if the QQQ goes up 1%, TQQ for on one day, TQQQ will go up 3%. And if the QQQ goes down 1%, well, TQQQ will go down 3%.
And if someone says, "Hey, I'm just going to buy and hold this," this fund has decay in it. You can't buy and hold it.
Yes, exactly. Because decay is happening for multiple reasons, but it's the borrowing costs of the fund to do that triple leverage. Again, that decay will kill your returns if you do buy and hold. So if we have a strategy that can work really well in the NASDAQ, well, applying it to the TQQQ, this is what it looks like. The same strategy, 23% drawdown since 2010. 8,724% overall return. And again, you see this blue line? That is the buy and hold. If you were to buy up here, that's about the year 2000, and you held on, that would be about an 80% drawdown. And if you held on to TQQ.
Right. Yeah, which obviously you wouldn't hold on to it. You would have sold and lost. Yeah.
Our green line there is our strategy. This is the TQQQ. Now, what we do is we look at because TQQ only goes back to 2010, and we have data on QQQ, right, with the NASDAQ 100, we have that data that goes back to the year 2000. We apply that strategy, we add the leverage, and we do a back test on it. Now we come up with a little less than 32% annual return and about a 40% drawdown. But look at the overall return. Again, this is over 24 years.
Mm-hmm.
And 81,000%. That's what an annual rate of 31% can do over 24 years. But that drawdown.
And that almost does not seem right. You look at that and you think, that can't be right. But you're earning a 200 or 300% higher return. Am I doing that right? A 200% return going from 10 to 30.
Mm-hmm. Mm-hmm.
And then applying that for 24 years. Yeah. I mean, that's like, I almost have a hard time believing it.
So, and this is why the compounding calculators, and I know a lot of people like them. I love to just get perspective here. So let's just say a $10,000 investment, 24 years ago, making 10% would have yielded you, the net ending balance would be $109,000. But you take that same 10,000 24 years ago, and you give yourself a 31% annual rate of return, you're going to have 15 million. All right, so huge difference, 141x, 141 times that the 10% return. Very powerful. Now that 24 years is a long time.
Yeah, it really is, isn't it?
But so what about 10 years? 10 years is a long time.
This is not an old man sport. You may not make it.
Yeah. This is, I think that we found this is nothing we have done is day trading. We don't do anything with scalping, anything that's in and out multiple times a day. Not at all. The swing trading, it really is. 10 years. You look at this, 31%. Over 10 years, we'll have an ending balance of 213,000, but 10% return, which is a pretty good buy and hold return, is going to yield you 27,000. So still almost 8 times the return. And I want to reiterate that anything with leverage is risky. You do not want to be buying and holding. You don't want to even be guessing. You want to really have something that you've built. We have done it ourselves. And again, the strategy is a swing trading strategy, so we're only in and out, like one trade every other, maybe 1 to 3 days. Sometimes we're out for a week or two if the market's going down. Sometimes we're in for a week if the market's really going up. But the point is the swing trades are really, really important in this strategy. You're in. Here's an example of a chart. On the 18th of January here, it goes up. We're out by the 22nd. We're in over here on the 24th of the month. We're out. Well, it's probably like the 26th. But anyway, every other day. This is on a 15-minute chart.
Now, what I'm actually excited about with this system is that I do consider myself a long-term, investor, but sometimes I might be a little bit too long-term, meaning a little bit too passive. So what I like about this strategy is I do consider myself more of a passive long-term investor, but sometimes I need a little bit of kick in order to get it to that next level. So this is not, an old man sport. Usually it's not a young man sport. No, this is not an old man sport because you can't be too old for this because it's take time to make, the efforts and the fruits, come to light. So what I do like about this is that it does force that long-term investing approach, but it's being done automatically for you that you can actually go in and look. So it's passive enough to where it's going to work, but it's active enough to where it keeps you engaged. it's something that you can actually have fun with.
Yeah, absolutely. Now TQQ is a ETF, and that's why you're watching this video, because this is about ETFs. Now it can be applied to futures. We love futures. We love how the automation works really well with futures. It does with because we don't have to worry about settlements, time periods.
It's like ultimate efficiency.
Yeah, very, very efficient doing the futures. You can do micro futures, E-mini futures. We have a lot of videos on that. You can subscribe to the channel and go through, and you can actually see our videos about the micro futures when we apply the strategy. But TQQQ and our strategy, very powerful and really can make potentially that 31%. In the description, we show you how we automate, and you can see the details in the description. If you like what we're doing here, be sure to subscribe, comment, and like. And we'll be happy to answer any questions you have in those comments.
All right. Hey, thanks again.